Hello everyone. We are Ding, Patricia and Stephanie. Let's enjoy our video presentation. Summary of the audit process. Phase I: plan and design an audit approach. Phase II: perform tests of controls and substantive tests of transactions. Phase III: perform analytical procedures and tests of details of balances. Phase IV: complete the audit and issue an audit report. For this topic we will more focus on Phase IV: completing the audit and issue an audit report. Definition of subsequent events are events occurring after period end and the date of the auditor's report and facts discovered after the date of the auditor's report. Auditor should consider the effect of subsequent event on the financial statement and on the auditor's report. Under subsequent event also, management of the entity has the responsibility for establishing policies and procedures to identify and account for subsequent events. Auditor should review the management's procedures to identify subsequent events and perform specific audit procedures designed to identify subsequent events. When auditor becomes aware of subsequent events which are material to the financial statements, the auditor should determine whether they have been properly accounted for or disclosed in the financial statements. This diagram is represent of the subsequent events period for earthware clothiers. The period from the date of the financial statements, the 30th of June 2017, to the date of the auditor's report, the 1st of August 2017, is sometimes referred to as the formal subsequent events period. During this time frame, auditor actively conducts audit procedure. On the period from the date of the audit report, the 1st of August 2017, to the date of issuance of the financial statements, the 15th of August 2017. The date the financial statements are issued is the date that the financial statement and audit report available to the third parties. In this situation where a fact becomes known to auditor at the date of the audit report, may cause the auditor to amend the audit report. Period 1. From year end, during the fieldwork but before signing audit report. Auditors have a responsibility to perform procedure to discover and evaluate all subsequent events that may have a material effect on the financial statements. Auditors also should make necessary adjustment or disclose in the financial statement. Period 2, from signing date to delivery of financial statement. Management are responsible to inform auditors of facts may affect the financial statement. If the auditor becomes aware of a fact which materially affect, the auditor should consider whether the financial statement need amendment, need to discuss with management and appropriate action should be taken. When management amends the financial statement, auditor need perform additional audit procedures and dated the financial statement with a new date. If management do not agree to amend the financial statement in situation where auditor believe they need to be amended, auditor should express qualified opinion or adverse opinion. Period 3, after delivery the report. Auditors have no responsibility to perform audit procedures. If the auditor becomes aware of a fact which materially affect, the auditor need to consider whether the financial statement need revision, should discuss with management and should take appropriate action. There are two types of subsequent events. First, non-adjusting event. Second, adjusting event. Non-adjusting events refer to conditions that did not exist at the balance sheet date but exist subsequent to that date. If material, need to be disclosed in the notes to the accounts. For example, purchase or disposal of a major business or subsidiary by the entity and issue of shares or bonds by the entity. Adjusting events is an events that affect the financial position and the financial statement on balance sheet date need to account for the events. As an example, the bankruptcy of a customer that occurs after the balance sheet date usually confirms that a loss existed at the balance sheet date on a trade receivable and the entity needs to adjust. Audit procedure for subsequent event include 1. Obtain an understanding of procedures management has established to ensure subsequent event are identified. 2. Inquire of management. 3. Read minutes of meetings of entities owners, management and those charged with governance. 4. Review budget, cash flow forecasts and their management report. 5. Examine the books of original entry, sales journal, purchases journal for subsequent events period and investigate unusual transactions. 6. Inquiring to lawyers, asking legal counsel about any litigation, claims and assessments against the entity. Contingent liabilities defines as a potential future obligation to an outside party for an unknown amount arising from activities that have already taken place. There will be a risk that it will not be completely and properly disclosed. Examples of contingencies include 1. Product warranties or defects. 2. Guarantees of obligation to others, example, corporate guarantee given to lenders for loans to another party. 3. Pending or threatened litigation, example, pending litigation or court cases and option to purchase. Audit procedure for finding contingencies. A. Reading the minutes of meetings of those charged with governance such as Board of Directors and Audit Committee. B. Reviewing contracts, loan agreements, leases and correspondence. C. Reviewing tax returns, tax liability and tax authority report. D. Inspecting other documents for possible guarantees. Litigation issues is about make appropriate inquiries about litigation and claims is an important part of completing the audit. These matters may have a material effect on the financial statements and thus required to be disclosed in the financial statements. Example of type of litigation are 1. Breach of contract. 2. Patent infringement. 3. Violation of government laws and regulation. Legal confirmation letter defines as a request for confirmation lawyers for identification of litigation cases. A legal confirmation letter sent by the management to the lawyers to provide the auditor with the following information. I. A list of claims or actions against the company. 2. A list of actions brought by the company. 3. A list of threatened and impending litigation and contingent liabilities. Commitments defines as an agreement to commit the entity to a set of fixed conditions in the future, regardless of what happens to profits or the economy as a whole. Often enter into long-term contractual commitments to acquire capital assets such as plant and machinery, to purchase raw material or to sell their products at a fixed price. Long-term commitments are usually identified through inquiry of management and other entity personnel during the audit of the revenue and purchasing processes. Accounting standards on derivatives and hedging require such commitments are disclosed in the notes to for going concern. International Standard of Auditing, ISA, requires the auditor to assess the risk of going concern problems at the planning stage and during the final review. Assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal course of the business. Its assumption is an important assumption underlying the preparation of financial statements. An entity is assumed to be able to continue as a going concern for a foreseeable future period of time in at least 12 months beyond year-end date. In terms of going concern considerations, auditors' responsibilities are to consider the appropriateness of the use of a going concern assumption in preparation of financial statements and also to disclose in the financial statements any material uncertainties about the entity's ability to continue as a going concern. There are 3 indications that auditor need to be alert for the going problems, which are operating indications, financial indications and other indications. Auditors need to be alert for the going problems. The financial indications are net liabilities or net current liabilities, substantial operating losses, inability to obtain financing, adverse key financial ratios, inability to pay creditor when full due, discontinuance of dividends, change from credit to cash on delivery transaction with the suppliers and difficult in complying with term of loan agreements. In terms of operating indications, there are loss of major market, franchise or principal supplier, shortage of important supplies and loss of management personnel. For the other indications, it is the pending legal proceedings against the entity. The steps to be taken by auditors are: first, Evaluate whether results of audit procedures performed during the course of audit provide any indication events that may cause substantial doubt. Second, obtain information about the management's plan to mitigate the problem, if there is any substantial doubt. The third steps is consider the adequacy of disclosures with respect to uncertainty and include an explanatory paragraph in audit report.
In terms of mitigating factors, there are two factors where auditor can satisfy with. One of them is the indications liabilities exceed assets, which mitigated by management's plan to maintain adequate cash. Another factor is that indication loss of principal, in which it mitigated by availability source of supply. The normal audit procedure should be taken when a question about going concern arise. There are analyze cash flow, profit forecast with management, review events after the period end for item affecting the entity's ability to continue as a going concern. Review minutes that relates to financial difficulties and any action discussed to overcome the problem. Inquire of the entity's lawyer regarding litigation and claims, obtain letter for financial support. For audit conclusion and report, once the appropriate evidence accumulated, auditor decide the question about going concern has been satisfactorily resolved and consider appropriate report. The table shows the going concern assumption considered by auditors.
The tables show another going concern assumptions considered by auditors. If the result of the going concern is inappropriate, if not so material, it is disqualified, while if material, it is adverse. In the case where it is not resolved, auditors should adequately disclose in the financial statement about the uncertainty. If not so material, it is disqualified, while if material, it is adverse. Next, accounting estimates. Auditors should obtain audit evidence regarding accounting estimates. Allowance to reduce inventory and receivable to their estimated realizable value. Management responsible that sometimes simple and complex. For example, it is simple to estimate accrued rental expenses compared to estimate the provision of a slow-moving inventory. We move to related party transaction. Auditor must perform audit procedure to obtain audit evidence regarding related party transactions and effect to financial statements. Auditors obtain information from client upon completion of the audit and ensure proper disclosure in the financial statements. The example of related party transactions are purchase of sales of goods, property and other capital assets. Rendering and receiving services. Leasing and rental agreement. Transfer under license agreement. Financing agreement, which refers to loans and equity contribution in cash or in kind. Auditor need to obtain written representation letter from management concerning. Audit procedures process is, first, review last year working paper and identify related party transactions. Second, review minutes, corporate structure and discuss with management. Third, confirm with related party on terms, amount and transactions. Fourth, discuss with management the purpose and nature of transactions. And the last process is inspect documentary evidence in the possession of the related party.
Management and auditors' responsibility on post-balance sheet events. Events after the balance sheet date are those events both favorable and unfavorable that occur between the balance sheet and when the financial statements are authorized for issue. First, auditor should consider the effect of subsequent event on the financial statement and on the auditor's report. Second, management has to establish policies and procedures to identify and account the subsequent events. Auditor is responsible to review the management's procedures to identify subsequent events and perform specific audit procedures designed to identify subsequent events. When the auditor is aware of the subsequent events which are material to the financial statements, they should determine whether they have been properly accounted or disclosed in the financial statements. Impact of events on audit report. The audit procedure for events occurring between the date of the financial statements and the date of the auditor's report is to identify events that may require adjustment of, or disclosure in, the financial statements would be performed as near as practicable to the date of the auditor's report. The auditors should take into account the auditor's risk assessment in determining the nature and extent of such audit procedures, which includes: first, obtain an understanding of any procedures management has established to ensure that subsequent events are identified. Second, inquiry of management and, where appropriate, those charged with governance as to whether any subsequent events have occurred which might affect the financial statements. Third, read minutes, if any, of the meetings, of the entity's owners, management and those charged with governance, that have been held after the date of the financial statements. And fourth, read the entity's latest subsequent interim financial statements, if any. There are 3 periods which can be identified by auditors on subsequent events review, as follow. Period 1, from year-end, during the fieldwork but before signing audit report. Period 2, from signing date to delivery of financial statement. Period 3, after delivery of the report. Period 1, from year-end, during the fieldwork but before signing audit report. Auditors have to perform procedure to discover and evaluate all subsequent events that may have a material effect on the financial statements. That means that they are able to make necessary adjustment or disclose in the financial statements. Period 2, from signing date to delivery of financial statement. Auditors does not have to perform audit procedures. However, management are responsible to inform auditors of facts may affect the financial statement. Period 3, after delivery of the report. Auditors have not to perform audit procedures. If the auditor becomes aware of a fact which materially affect, the auditor need to consider whether the financial statement need revision. They should discuss with management and take appropriate actions. Key audit matters. Key audit matters are those matters that, in the auditor's professional judgment and most significance in the audit of the financial statements of the current period, the auditor should determine which of the matters communicated with those charged with governance are the key audit matters. In making the determination, auditor should take into account areas of significant auditor attention in performing the audit, including areas identified as significant risks in accordance with standard, areas in which the auditor encountered significant difficulty during the audit, including with respect to obtaining sufficient appropriate audit evidence and circumstances that required significant modification of the auditor's planned approach to the audit, including as a result of the identification of a significant deficiency in internal control. The auditor should document the matters that will be communicated as key audit matters, and the significant professional judgments made in reaching this determination, in accordance with standard. If the auditor determines that there are no key audit matters to communicate in the auditor's report, they should discuss the conclusion with the engagement quality control reviewer, for those engagements where one has been appointed and need to communicate the conclusion with those charged with governance. The professional judgments for the matters determined to be key audit matters are likely to be supported by the documentation of the auditor's communications with those charged with governance.